Hello traders at Global Prime, it's Ivan Legado, Market Insights commentator, and today I want to deliver a flash educational video where I'm going to be looking really short. I want to give you a look at really what's going on under the hood about the concept of divergences in the US dollar index, one that I try to hammer home day in and day out in my daily technical / intermarket analysis. Okay, but before we proceed into the practical example that I want to share with you today, first of all, there's an important distinction off the bat that is required. Now, as you may know, those that are familiar with my work, unlike the mainstream way that exists out there to monitor the overall performance of the US dollar index, or DXY as we know it, which has, let me just bring this table here, this pie chart. The US dollar index, or DXY, has a euro weighting of about 60%, and doesn't even consider the performance of the oceanic currencies nor the Chinese yuan, for example. Okay, now personally myself, as you know, I like to monitor the performance of the US dollar against a basket of other 7 currencies, or as I call it, I like to monitor the G8 FX complex, and I will elaborate on that in a minute. Now, the reason why that is because, in my personal opinion, this is a more accurate way of expressing the real true strength or weakness in the US dollar. Some actually may argue otherwise, predicated on the basis that the euro will always have more weight than the New Zealand, for instance, just because there's a lot more transactions being, going through the markets in euro denominated terms than in New Zealand terms, and that's absolutely true. But personally, the way that I see it is that if we are going through a patch of weakness in the euro dollar, that is going to be telling us, hey, watch out, because there is this overall US dollar strength, then that should also be reflected through a lower New Zealand US dollar. And if that is not the case, and we have, like, imagine this chart. This is a euro US dollar chart of the 4-hour. If we are going lower, yet the New Zealand US dollar is going higher, or is actually range bounding, that is actually going to tell us that two options exist: that the New Zealand currency index is very strong, and that obviously is going to offset that strength in the US dollar, or that there is no real true strength in the US dollar. Now, in the majority of cases, based on my experience, based on my backtesting, when you actually throw into the mix as part of the equation 8 currencies, the G8 FX, it's going to give you a more accurate picture of the overall performance of the US dollar across the board, when you are able to account for each of these 8 currencies on a equally distributed basis. Okay, which is why I like to monitor, as I said, this US dollar index on an equally distributed basis, which is going to assign a weighting of about 14.3%. Let me give you the example. So essentially, and the formula. So essentially, this is the formula as it stands right now today, and you will notice that the formula has 7 currency pairs: euro US dollar, dollar JPY, pound US dollar, dollar Swiss franc, dollar Canadian, Aussie US dollar, and New Zealand US dollar. It also needs to account, obviously, for the harmonization of volatility, or the normalization of volatility. So that's why I'm adding the actual value of that currency in the denominator, so that the movements in one that is more volatile than the other is not going to be out of whack. And so, with that being said, if I were to calculate here 100 divided by 7 pairs, that's going to be part of this equation, it's going to give us a 14.28. Okay, so the US dollar index has a weighting of 14.3% that is going to be, as I said, that these 7 pairs will comprise the formula of this US dollar index. Okay, so with that now out of the way, as I said, I want to provide an example of what's really occurring in the granular scheme of things in the actual, under the hood, when you see me calling a positive or negative divergence in a US dollar pair. In this case, we're going to be looking at the Euro US dollar against the actual US dollar index. And for that, I want you to pay attention to what I've got overlaid here in the main chart. In green, I have my proprietary US dollar index. In magenta line, we have the mainstream US dollar index, or DXY. In a candle type chart, I have Euro US dollar. And now in the following panes at the bottom, we have GBP US dollar. I'm just going to go from top down, from top to bottom in this order. GBP US dollar, Canadian US dollar, New Zealand US dollar, Australian US dollar, JPY US dollar, and last is the CHF, or Swiss franc US dollar. Now, pay attention here. Wait a second. Let's go back to, okay, pay attention here. At this point in time, on April the 6th, I was calling a major divergence, and it would be not, the odds would not be stacked in the favor of those supporting sell side continuation in this market. And the reason being is because we had a Euro US dollar that was testing a level of support right there at a time that the performance, the overall performance in US dollar terms across the board was much weaker. Remember, this is the inverted version of the US dollar index, okay? So that we can then match up a bullish directional bias with a bullish directional bias in the Euro US dollar, okay? So you will notice here that if you were to monitor this exact same type of divergence, or you were to spot or try to identify this divergence through the DXY, that would never be possible, because at the time that the Euro US dollar was testing this level of support for the second time, therefore we can have this anchoring point, the DXY kept going lower. Why is that? Because the DXY in an almost 60% the weighting is almost 60%. That's what I was trying to say, okay? So essentially, the movements in the Euro US dollar are almost always going to be a copy of that of the DXY, or the other way around. The DXY movements are going to be almost always a copy of the Euro US dollar. Therefore, it's going to be much tougher to actually spot divergences. That may actually not apply the same way in other pairs, just because Euro US dollar may have a different performance as opposed to GBP US dollar, US dollar JPY, etc. But you get my point. Now, let's understand what was going on under the hood here, so as to why this green line kept moving higher at a time that the Euro US dollar was testing a level of support. And to me, that divergence essentially means that there was a mispricing. There was a mispricing here, right? So let's look at what was going on here. GBP US dollar was around the same level as the Euro US dollar. You can see here that it's almost flat, the line from the point of the first touch of support at the time of that happening in Euro US dollar and when that retest occurred. But notice here that we had Canadian US dollar going higher. We had Aussie US dollar also moving higher. New Zealand US dollar also moving higher. We had a flattish JPY and also a flattish CHF index. So essentially what this translates into is that in the grand scheme of things, which is going to be then expressed through this green line, remember that this green line is going to be weighted on a 14.3% basis per each individual currency. It was telling us, watch out, because this weakness in the euro US dollar is not being justified by having true strength or real strength in US dollar terms across the board. Why is that? We had a higher Canadian US dollar during this period of time, a higher Aussie US dollar, a higher New Zealand US dollar, and then we had a bit of a neutral picture in the rest of those currency pairs. So bottom line is that at this point right there, from a value perspective, there seems to be a mismatch. There seems to be a mispricing of the pair. All right, so hopefully you get the point. Let's now look at another example. Notice here that the DXY was flat-lined, yet the US dollar index kept going higher, the one that I like to monitor. What did we have in the euro US dollar? Let's look at it. We had a level of support, and here notice that the price poked lower and it failed. Now we need to ask ourselves, what might explain the downside failure in the US dollar? And once again, if you go to my videos on April the 9th, I did argue that this would be a market that would not be warranted, would not be justifying trading lower based on the performance of the US dollar, which kept weakening at a time that the euro US dollar was actually being exchanged at too low a level. And if we go now and look under the hood, we would realize the following. We had a GBP US dollar that kept going higher. Canadian US dollar, it was quite flattish, okay? So Canadian US dollar wasn't really telling us much. The Aussie US dollar kept going higher. Same with the New Zealand US dollar. The Japanese yen against the US dollar was flatlined. And here we had the Swiss franc against the US dollar, which was also flatlined. So the total aggregation of these flows, again, is expressed through the US dollar index. And that tells us that we had three pairs that were on a neutral position through this period of time, but we had three others where the pound, the Aussie, and the New Zealand were trading higher. So you would be really like, you would not be able to make a case that this trading lower right here in the euro US dollar was being justified by having real strength in the US dollar. When that is the case, more often than not, you're going to see that this is just simply a manipulation of the market to catch those that are weak-handed in the wrong side. They're going to actually grab their hands on whatever liquidity exists before the markup in price. And that was the divergence I was just telling you about in the previous videos. All right. And one more example. We've seen this retest in the euro US dollar, retest of support at a time that the US dollar index was telling us, hey, once again, divergence exists. And that was not possible if you are to monitor the DXY through the magenta line. Let's now understand what was going on in here. We had GBP US dollar pretty much flat. However, we had a higher Canadian US dollar, higher New Zealand US dollar, higher Aussie US dollar, slightly higher JPY US dollar, and slightly lower CHF US dollar. We had four markets going higher against the US dollar. We had one that went nowhere, two that went pretty much nowhere. So when that happens, once again, through this line, we get a clue, we get a communication. The market does a great job, this index does a great job in telegraphing that you should be on high alert for, once again, this breakout not to work, to see a failed breakout, and then see that the flows are going to turn around and visit the opposite swing high, as we've seen. Okay, so hopefully this video helps you to understand why is it that I monitor the US dollar index as a accurate prediction of what are the aggregate flows telling us. Are we justifying a move to break a level of support or resistance, or we are not? If we are not, the most likely scenario, as I've shown you in this video, is that we're going to see a turnaround of flows because the market does perceive that there is a potential value trade to be made. And if that is the case, then you're going to see that the market at the bare minimum is going to be traveling to the opposing level of resistance if we were testing support, or the other way around. Okay, this was the educational video that I wanted to put out for today. Hopefully you have now gotten a little bit better at the interpretation of the divergences that exist in the US dollar index. Hopefully you can gain value, you can keep gaining value out of these videos. If you do so, do not forget that I would appreciate if you smash the like button, you share the video around, and let's keep growing this channel together. It is Ivan Legado, Market Insights commentator at Global Prime. I'll see you tomorrow. Cheers.